that makes some noise.
Makes some noise on there. I better not do that.
You can do it down here.
All right, you ready?
Ready.
Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while sunbathing poolside in Tahoe. This is Through the Pines. On this episode, we'll chat current market conditions. And so what is the overall current economy looking like right now, the inflation update, Fed rates, how does higher interest rates eventually lead to a recession? Does it? Will we see one? We will answer that and along with some of these questions on this episode of Through the Pines. Introducing Forbes' best in-state wealth management teams for Utah, Baxter and Associates. Rex Baxter is in Banning 1 here, along with Brandon. Hey, Brandon, I heard you have a sailboat. Do you ever get on that much?
I do.
Okay, very good. Advisor Hub, fastest growing advisors to watch under $1 billion. Rex, what are you going to say?
I wasn't going to say. I just like the way you say $1 billion.
Yeah, $1 billion. And receivers of the Ameriprise Client Experience Award. That was rigged. I'm telling you. I have no idea.
We worked hard for that.
I bet. No, I'm sure. Our financial wizards, Rex and Brandon here in studio, which is great. I love when they're here in the trailer with us on this episode of Through the Pines. You can find them at planwithbaxter.com. Planwithbaxter.com. Brandon Smith, Rex Baxter. Okay, like our Facebook page, follow our Instagram at Pines_podcast, subscribe to our YouTube channel, Through the Pines Podcast. Let's dive into the quarterly market update. This is, are we in a recession? Are we not in a recession? This is the longest build up to a recession I've ever heard of in my life.
Yeah.
Brandon, what's it looking like so far?
Yeah, in fact, you echo, I was listening to an economist that said, if this ends up being a recession, this will be the most widely anticipated forecasted recession of all time.
Yeah, of all time.
Usually they kind of sneak up on us. But yeah, we want to do this podcast and review kind of high level where we're at, how do we get to where we're at today, and then look at a handful of different economists' opinions. And, it's always fun because there's always a range of optimistic, pessimistic, and so sometimes it's fun to hear their opinions and discuss them. So
before you jump in, let me just note that if you're listening to this, and this is being recorded in the middle of July 2023. So we're looking back on the past 6 months to 2 years.
Yeah.
Right?
Yep. Yeah. Exactly. Yeah. So no surprise to anybody, right? COVID hit. We printed an incredible amount of money, which also led to a lot of inflation, right? We all knew that would cause inflation. It came a lot faster than most people thought. So what did the Federal Reserve do? They started tightening interest rates. They raised interest rates higher. And it's funny, right? Because you say, well, do interest rates directly correspond with inflation? And the answer is no, right? We brought interest rates down to zero for a decade and had very, very minimal inflation. So there's not really a direct correlation. However, it can hinder the economy, right? You raise those interest rates up, it makes it more expensive for homeowners to buy a new house, to do a new project. It makes it more expensive for businesses to invest in things. And so
it puts over-leveraged banks out of business.
Yeah, that too. but even in banks and insurance companies, things like that, it slows them down. Mm-hmm. and that slowdown, when you slow down a business, when you slow down consumers, that can slow down the inflation rate, because inflation is essentially too many people trying to buy too few goods, right? And so if you limit the ability for the buyers to go out and buy those goods, then technically, hopefully, the cost of those goods comes down with competition.
Quick question, just you guys, since I have you both here in the trailer, is having a Fed control interest rates good or bad do you guys believe that this is the way the system should work, or do you think that the economy should just sort of play itself out? The Fed shouldn't necessarily exist, and whatever happens.
Well, I think that's an interesting question, and it's one that gets asked a lot, especially when we're in interest rate hiking or tightening cycles. Yeah. Right? As everybody's saying, should we really have a Fed? And the problem is that I'm not sure what the next best alternative is, right? If you don't have a Fed, and we didn't have a Fed to kind of bring inflation into control, how rampant would inflation get at this point to take the money out of the money supply? And it would have to get pretty hefty. I mean, even 9%, where it peaked at 9.1, that's pretty high inflation for year over year, cost of goods. So until somebody comes up with a better system, even though it's a flawed system, I think it's the best system that we have still today.
Sounds good.
The argument would be the gold standard, right? That's what the number one argument. Hey, let's get one fixed thing. That way the Fed can't print money and we don't see inflation like that. The problem, though, is you can't control money supply. And that's significant. And I think it's underlooked. When we had baby boomers coming out and they were all trying to buy homes, they all needed capital to get their lives rolling. And we had the Fed trying to kind of hold us to more of a gold standard-esque, policy. It wasn't the gold standard, but it was similar, being really tight like that. And if you don't expand that money supply, then people can't go out and pursue their dreams, and cost of capital goes way up. And ultimately, I did a paper on this in college. The oftentimes the answer isn't the bad guy isn't the policy. The bad guy is violent change, right? When we have volatility, that's what really disrupts markets. And having a Fed being able to adjust and play with interest rates and play with money supply, if they're doing it to keep things kind of even keel, that can be beneficial. But it's a double-edged sword. They can also do crazy stuff like print an incredible amount of money all at once and cause some headaches. So I don't know. I agree with Rex. I think it is. I personally think it's probably a decent system with flaws. I don't know what else to do, though, other than just be a little bit more moderate with our policy within the Fed.
And they are still raising rates in July 2023. Like, what do you think they're going to do the rest of the year? Like, what are we looking like here?
So the debate rages on.
Yeah.
Right?
Yeah.
And so, we've seen a lot of opinions on they're paused and done to they're paused and one more, two more. And I've even seen opinions that say, oh no, we have a long ways to go. So, I've seen everything across the board. Our team's opinion, our thought is that we probably have one or two more rate hikes still to go until we're done with this cycle, is our opinion, which is kind of middle of the road, probably as far as opinions are concerned.
But so with that said, good thought. How or why would that affect your financial planning?
Well, it affects your financial planning in a lot of different ways, because if all of a sudden, for the last decade or longer, you haven't been able to earn very much money on really conservative assets. And so on your cash, on your money markets, on your CDs, on your bonds, the interest rates have been extremely low. And so your overall rate of return for your portfolio has been muted because of part of your portfolio being more conservative and having a low rate of return. And now that we're experiencing higher interest rates and higher rates of return, or future projected rates of return on money markets and CDs and bonds, then that will help that part of the portfolio to combat part of the inflation hit that we've taken over the last couple of years. And so that part's been a net positive.
So I've heard you mention that you can't predict bottoms before, and I've heard people argue, well, why would you be in the market right now and you can basically get a guaranteed 5% return on your money instead of dealing with volatility? So what's your argument or stance on that?
Well, do you want to take that, Brandon? You jumped right in.
I love that one. Yeah.
Go ahead, Brandon.
It's a tempting proposition, right? Especially where some bond portfolio, I mean, we can get a 4 to 6% rate of return, and get some duration, meaning lock in those rates for longer on that. But I think you go back and you look at historical market returns and assuming that, the S&P 500 will do 8-10% on average, that's significant. 1% makes a big difference, right? And to make a change between 5 to 8%, that's significant. And so, if we've got money that we don't need for 10, 15, 20 years, do you want to lock that in at 5%, or should we put it in the market where we, historically speaking, can hit 8 or 10%? And I think that answer, it makes a meaningful difference on a financial plan to have that much asset growing that much more efficiently.
Yeah, it all depends on who you are, of course, and where you're at in your
right. And we're not all saying all one way or all the other. In fact, you should probably have a blend, right? But to completely neglect one of the best performing asset classes would probably be a mistake.
Not only that, but lots of times people will ask that question, and so they may say, hey, look, I'm going to go and put it in a money market or put it in a CD or whatever the case may be. And when rates roll over, when rates start to go back down, then that puts you in a little bit of a dilemma, right? Because now all of a sudden you've got liquid money paying you lower than what you were doing before, when you could have locked it up for a longer period of time, or we could be experiencing better rates of return in overall, riskier assets. And again, those are riskier assets, so there's different characteristics there. But it is a challenging time, and it's interesting. It reminds me a little bit of the 80s, to where you had CD rates around 12% back in the 80s, and mortgages up around 18 or 19%. Matter of fact, I even remember seeing some treasuries at 14 or 15% on some treasury bonds from back in the 80s. And yet everybody wanted their money in the savings account, because the savings account was paying 10% in liquid. And then all of a sudden, when rates rolled over, that 10% on the savings account goes down to 2, and they could have had that money locked up for 20 years at 14%, right? And so that gets to be a little bit tricky. And I think that when you get into higher rate situations, and this isn't even higher rate yet. I mean, it feels high because we're coming from zero for so long, or so low. But we're really not in an extreme high rate situation. This is almost just kind of average rates at this point in time. But it's easy to kind of get punch drunk, if you will, a little bit on short-term rates and get really short-sighted, and then that kind of comes back to haunt you down the road.
And when you say locked up, I mean, it's locked up only in a good way, right?
Right.
We lock in at 14%, but if you want to sell it, if rates come down, we can sell it, and usually sell it for a premium. And so you can sell it at any time. It's just being able to lock in those higher rates, and it can, really be beneficial.
No, it's good.
So,
It's good
Brandon, I took you off track a little bit.
that's all right.
We were talking about the Fed rates and where we're going.
Yeah, so the Fed starts fighting inflation with higher interest rates, and those higher interest rates have pros and cons. The benefits, obviously, as we've talked about, it's nice for retirees to see some income. It kind of normalizes money, right? Money should be worth something. But the downside is that it makes it more difficult oftentimes for businesses to operate. Business, and we've seen this obviously in the banking sector. I know insurance companies can be having a hard time if they've got a lot of these low interest rate, long duration bonds. And so, and then just in large, right, an economy has a hard time when you have those higher interest rates. Those higher interest rates make it more difficult for people to go out and buy a house, to build an addition to the house, to buy a new car. They make it hard for businesses to go invest more in their future business. And so what that does, and kind of the idea with these higher rates, is that you raise the rates higher, make it a little bit harder to buy stuff, and therefore inflation slows down, right? Because inflation essentially is too many people trying to buy too few goods. And so if you make it harder for those people to go buy those goods, you get fewer people buying for them, and it should bring the cost of those goods down. And that's kind of like the overall strategy behind raising these interest rates.
So I saw Mr. Wonderful put out a warning, Mr. Wonderful Shark Tank, put out a warning that he's nervous about a cash crunch for small businesses not being able to get lending and not being able to grow. And I think, Brandon, what you're saying is that, but maybe that needs to happen so that interest rates come down, or
Absolutely. It's by design. Yeah. I mean, the Fed is intentionally trying to slow down the economy, and it's, it feels good to grow fast, but there is such a thing as too fast. And so, there's the give and the take, right? Housing is a perfect example. The Fed could solve that overnight if they wanted to. They could bring the rates down. They could buy, mortgage-backed security. I mean, they can adjust those rates, not exactly, but they can, large scale move them around. But they don't. And why don't they? Well, because they're trying to cool this inflation down. Even though we have a housing issue in the United States, we have way too few housing units and not enough houses being built. It's kind of, which one are we more afraid of, having too few houses or too high of inflation? And they've chosen inflation to fight that. And so here we are, right? And we're in this dilemma of, hey, is this too much tightening or raising rates too much, or is this all going to work out, fight the inflation like we need, and life will go on? And so those are kind of the opinions that we're going to read today. And so The first one actually is by Brian Westbury. He's the chief economist at First Trust. Really good, really smart guy. Has been very optimistic for a while, but recently has gotten fairly pessimistic. And so here, let me just...
I think right before you read that, I think an interesting statement on that, right? Because he has been really kind of optimistic or bullish, as we say, about the economy for quite a while. And now to hear him be bearish is kind of interesting, because most economists, even though they claim to be kind of agnostic on kind of a bullish or bearish or an optimistic or pessimistic viewpoint, most of them have a strong bias towards one side or the other. And so lots of times they'll kind of be nicknamed, oh, he's a perma-bull, or he's a perma-bear, and he's always bullish, or he's always bearish, or he's always optimistic, or always pessimistic. And so and most economists kind of fall into those camps. And so it's interesting when you find a couple that do kind of go back and forth. It's kind of interesting to hear why they're going back and forth on their opinions.
Right. Yeah. So he says, if investors thought the Fed, meaning the Federal Reserve, were finished or nearly finished because it had tightened monetary policy enough to induce a recession sometime soon, then we don't think stocks would be going up like they have as of late. Kind of meaning like if people really thought the Fed was finished and that was going to throw us into a recession, then the stock market wouldn't be coming up like we've seen it go up. He said instead, what makes more sense is that stock market investors think the Fed is nearly done and will not induce a recession. That it has somehow positioned monetary policy to be tight enough to bring inflation back down to its 2% target, but not so tight that we have a recession, right? So basically saying, hey, based on what the stock market's doing, it kind of feels like people in general feel like the Fed has actually done their job this time, right? That they've actually raised rates high enough to fight inflation, but not too high to throw us into a recession. He says, we hope they're right about this. Wouldn't it be great? Unfortunately, we still have strong doubts and think the U.S. is headed for a recession. If monetary policy is tight enough to fix inflation, it's going to hurt economic output as well. And that's essentially just their model, right? Their model, because all economists kind of have models they use, and they're just saying, hey, look, if we really are going to tighten it tight enough down to get down to this 2% target, there's no way we don't go into a recession.
Yeah, it's an interesting, thesis and opinion. And again, he is an extremely bright guy. And it is interesting to hear him kind of correlate recent market activity, because the market has had a very strong first half of this year, a recovery of sorts, if you will, from kind of an October or September low of last year. And it's been extremely optimistic. And yet, most people wouldn't be that optimistic if they felt like we were going into a recession. And to drive those prices up that hard and that fast again. And so it is an interesting viewpoint to hear that.
Right. And let me read this next little bit, because I think this is where he explains. He says, regardless, the Fed remains far from declaring victory over inflation. And he gives kind of some stats on that. He said, to put this in perspective, let's guess that the Fed would like to see PCE inflation, which is just another measure, one of the measures the Fed watches. Let's guess that the Fed would like to see PCE inflation at or near 2% within 18 months, which would be late 2024. Looking back at the past 60 years, the only time the PCE inflation rate has dropped that much has been during or right after recessions. Maybe this time is different, but we remain skeptical. And so essentially saying, hey, if the Fed really, and I think he's holding the Fed to their word, right? Saying, all right, Fed, like if you really are going to hurt us so long and you're going to stay to it, which they kind of have so far, if you're really going to do this enough to drop inflation as hard as you're saying you need to drop inflation in this time frame, it's always caused a recession in the past, right? And that's kind of their viewpoint. And I don't know that they think it's like a deep 2008 recession, but just that, hey, if you're really going to fight inflation, if you're really going to bring it down that low, then that's going to cause a recession. And I tend to kind of agree with them. I guess maybe am on the side of where the market's at too, saying, hey, we've already seen inflation come down dramatically. And would it surprise us if the Fed kind of backed off of that stance a little bit and kind of said, all right, hey, inflation's at 3.5%, which could happen really pretty soon, is say, hey, we can sit at 3.5%, especially with the election coming up.
Well, I was just going to say, how does politics play into that, and should it or does it? Because if the Fed delays at the right time or wrong time, depending on what side you're on, then an election comes up and you're either in the middle of a recession or just popping out of one, and how does that affect voting? And do the politicians who control the things have control over the Fed to make decisions that would affect policy like that?
So the Fed is supposed to be independent, right? And
Sure.
we all know supposed to or not.
We're all independent,
right? So independent of political, pressure, and are they or aren't they? We could debate that until the end of the earth, kind of thing. So who knows on that piece? I do know that typically on an election year, that most of the time the politicians want to go into an election year in a fairly strong economy, because they want to get reelected, and it's hard to get reelected on either side of the aisle if we're in a bad economy.
Sure.
And so I think,
and I guess if it's going down, you could say, but I'm here to fix it,
yeah, but they were there to
cause it.
right.
Yeah.
So that's a tough argument.
Yeah.
Right. That I think kind of falls a little bit on deaf ears.
Sure.
Which is why I think that they do what they can to try and encourage a more stable and a little bit stronger economy. I think on Brian Westbury and talking about the Fed, I think the piece that that he doesn't address on there is kind of the speediness or the quickness that the Fed does this with, right? I think that the more aggressive the Fed is, the quicker that they act and react, the more likely that Brian might be right on his comments. I think the slower the Fed is to try and hit that target, then if they can kind of bleed that out over a longer period of time, then it may be that the Fed is successful in bringing in a little bit of that softer landing. And so I think a lot of it comes down to how aggressive is the Fed going to be at trying to hit that 2% target.
Okay, interesting stuff. What else, Brandon?
So the next one,
Yeah.
Let's move on to Jack Janowitz, and I think
Janowitz?
yeah, he's with Natixis, and kind of has the opposite perspective. His and it's been interesting
This is
reading.
what blows my mind.
Following
This is what these people do, and they have opposite perspectives.
And both of them are very smart. I mean, nobody's just shooting at the hip, but his. And reading his stuff over the last months and stuff has been really interesting, because he's like, hey, this is it, right? This is the soft landing that everyone hoped for. Like, we couldn't have painted a better picture, right? If we would have rewound to a year ago or 2 years ago, and when we were looking at this, like, holy cow, this looked, there's some real scary stuff. If we would have seen the data from today, then we'd be like, oh, holy cow, like it might work this time, right? And that's kind of he's like, hey, all these people that say a recession is imminent, that it's all going to end, like what else do they want to see, right? What else is there? And so anyway, his this perspective I thought was interesting. He said it's increasingly clear that it's not the Fed that's hawkish, but rather the economy. Growth has been reaccelerating, perhaps most notably in the interest rate sensitive segments of the economy, such as housing, at a time when those supposed long and variable lags should be kicking in, right? So, like, has housing just completely collapsed and fallen? You would have thought so, right? You raise mortgage rates from 3 to 7, right? Overnight, you'd think that housing would completely collapse. That's what, Econ 101 would tell you. It hasn't. And why hasn't it? Well, he goes on kind of, there's some other things going on here that beyond just interest rates and housing values. He said, instead, those lags appear to have been very short and are now waning in impact. And don't forget about all those headwinds to growth in 2022 that have flipped to tailwinds in 2023, which we've seen, right? I mean, all of a sudden, we're seeing those adjustments. Fiscal spending, inventory restocking, rising real incomes, etc. It's not that the dots moved higher because the Fed is being hawkish. They moved higher because the economy is holding up better than anticipated. The labor market is strong, but normalizing, and core inflation has been a bit stickier than and core inflation has been a bit stickier than expected in 2023. All very valid points, right? That essentially, these are the arguments that, hey, this is going to be able to kind of pull out and normalize. And if the Fed stopped raising rates today, does inflation take off? I don't know that any of us can really answer that, right? Because it's so hard to predict. And that's where it just kind of comes down to, all right, how much of the effect of this printing and spending have we already felt, and how much is to come? And that's something that Brian Westbury kind of talks about too, is, hey, we still haven't felt the full effects of all this printing. More's to come. Whereas other people are saying, hey, we really have felt quite a bit of it. We're starting to see it wear off. Where's the new negative going to come from?
I do find it kind of interesting, and we'll get into this later in the podcast, but I find it kind of interesting that you have these economists of these different asset management firms that have opinions, right? And so you've got, Brian Westbury that's a little bit on the bearish side, a little bit on the pessimistic side. You've got Janowicz that's a little bit on the positive side, the bullish side. And yet when you look at the overall asset allocation that they're projecting for like a moderate investor, right? Let's say, for example, a moderate investor may normally have 60% exposed to the equity markets and 40% exposed to the bond or the fixed income or more conservative assets. And so when you get a bearish case like that, all of a sudden those asset management firms, they've got this big bearish case. Watch out, the sky's going to fall. And the portfolio goes from 60% in the equities to maybe 56%, right? They're like, oh yeah, this is our bearish portfolio. And then you get somebody else on the bullish side that says, oh no, the sun's going to rise in the morning. It's a new day. We're going on. And so that 60-40 portfolio, instead of 60% equities, let's go to 62 or 63, right? And so it's just kind of interesting.
Really? They only changed that little?
Yeah.
Absolutely.
Well, that was my question, is because so this information that you get, I don't know, daily, weekly, whatever, what do you do? What do you do with that information, and how does it affect portfolios and what you tell your clients?
Yeah, so I think that's a good question, and I want to address that in a little bit more depth after we go through a couple more of these opinions. And so I'm going to have you table that question for just a minute, and we'll come back to it.
Okay.
Perfect. So let's move on. This one's from Ameriprise. And Russell Price, he's our chief economist. He's received several awards. His last one was, what was it?
Most consistent.
Greatest economist ever.
Pretty close.
Economic guru.
Yeah.
No, I think it was that he was most consistent for like 7 years, some number of years running in the U.S. and like number 3 in the world or something like that. For consistency.
Yeah, he's been on fire, and it's actual. What has it actually come to fruition? What you're saying? So anyway, he said we continue to recommend a slight overweight to fixed income and cash investments, but believe opportunities are forming across the stock market for longer term investors. And so just like Rex was saying, right, a slight overweight to some of these safer things, because there is that scare of a recession. But then that second part, I think, is really key. But we believe opportunities are forming across the stock market for longer term investors. And what does that mean? Well, longer term investors, it basically is saying, hey, this looks like this is probably a pretty decent time to buy if your time frame is like 10 years or 15 years, and you look back, 10 years ago, and you look at our where we're at today. Today's probably one of those days that you wish you would have just bought, right? Now, is it at the bottom? Is that a peak and it's going to come down? It's hard to say. But when you put it in true perspective, we've got quite a bit, things look good, and this is kind of an opportunity to buy. If you're a short-term investor, there's still quite a bit of variability out there, and that's why they're saying, hey, we're probably maybe leaning just a little bit to cash and fixed income still.
Brandon, is there any consideration in reports that you're seeing about new markets? In other words, when the internet came out, that changed the world. AI is the new thing, and I hear this is going to be something that we live with in the future, to where it can change a lot, and so much so that it could be an enormous run up in markets. We don't know, but to me that just feels like, as somebody on the sidelines or just looking at the market from like a normal person is if you're not in the market, then you're going to miss all of that anyway.
So just really quick before you handle that, my personal belief is that stock prices follow earnings, right? The more a company makes, the more a company is worth over time. In between is excitement and fear that drives all the volatility in between that kind of earnings trend line over time. And so as artificial intelligence starts to become monetized inside of companies to where it's enhancing the earnings ability of a company, then I think those companies will tend to flourish because they'll have more earnings and everything else. But I think what you're seeing right now, which is very common on the front end of these curves, is excitement, right? Excitement for the future. And when will that be? And you saw very similar things, building up into the tech bubble. And I'm not saying that this is similar to the tech bubble, but I am saying that you find kind of similar patterns and trends. Mm-hmm. But in the late 90s, anything with a .com after its name just about skyrocketed.
Sure.
Right? And if you go back into, the 1910s and 20s with car companies, right? That you had 600 car companies across the country, and we ended up with, 3. And so I think that you're going to find similar patterns in general to where certain companies that can monetize that and turn that into earnings, absolutely, they should do really, really well. And from a big picture standpoint. In the meantime, between now and when that gets monetized, you're going to have a lot of excitement and fear and a lot of volatility and guessing because nobody can predict that future. Nobody knows which companies those are going to be. And anybody that tells you that they can predict the future, you might want to question a little bit deeper.
You said earlier that there's some economists who are lean bear, some lean bull, even though they're not supposed to. My thoughts, and this is why I personally brought up the AI situation, is like if I'm a pessimist and I think bad things are going to happen, well, am I ever going to be rich? Because I'm always going to be scared, and I'm going to be in these super conservative investments or something forever. However, if you're sort of more optimistic but cautiously optimistic, and you see new technology come online like AI, me personally, this is just me speaking, I think there's going to be an enormous boom here soon. I don't know when, but over the next 10, 20 years. And so if you have that much timeline, why would you be sitting out?
Well, I think you can make wise investments on either side, right? I think that there are more conservative traditional kinds of companies and investments that will produce very strong returns over time, right? And so if you're in the camp of I'm bearish, I think AI is going to lead us into terrible atrocities. Then those people typically are investing in more traditional.
We're going to nuke ourselves.
right. So yeah, let's not do that.
It's not funny.
Let's choose the other path.
Okay.
So I think there's other investments to be in that will still do just fine for you. I think if you're in the camp of yes, AI is going to be an enormous disruptor and revolutionize a lot of industries and be extremely profitable, I think that's a very volatile road to go down because you're going to experience some extreme volatility. But I think again that over time you're going to get some great returns as well. And so I think at the end of the day, the point is that you need to be well diversified. And if you're in the camp where you're comfortable with some of that extreme volatility, that's okay. There's nothing wrong with that. Just make sure that it's congruent with the rest of your portfolio, that the rest of your portfolio is structured so that if you're either wrong or you need access to funds for certain goals, that you're not going to get caught to where that part of your portfolio is down and you have nowhere to access money without taking enormous losses.
Got you. Brandon?
I think we often don't recognize what we don't know. And that's, you look at the tech bubble, which I think is the perfect example. There was such an overexuberance of excitement around websites, and these websites, all you had to have was a .com at the end and a couple clicks, and your stock took off. And the irony of it is, in hindsight, we can look back and be like, holy cow, you need more than a website, to make profits. But man, did we have any idea how beneficial websites and online collaboration and e-signature and all of the benefits, Amazon, the list goes on, at how beneficial the internet and websites have been to our productivity as a nation, I don't think anybody had any idea just how beneficial that would be. But they put all their exuberance in the wrong place, right? They put it all in just like a company with a website, whereas the website was going to be the beneficial. But what really was beneficial? It was companies using the technology to better their offering. And I think AI will likely be very similar. It's not necessarily just the technology of AI, but the implementation of that AI. And I think we have yet to really understand how that's going to benefit. I think it will be there. And I think that's where you get some of this excitement, right? People saying, I'm going to throw more money in the stock market because holy cow, profits are coming. But when, is it in 2 years? Is it in 5 years? Is it in 10 years? Hard to say. My guess is it's earlier, but it's really hard to say and to what degree.
Rex?
I think if you're always early to these kinds of exciting, new, fresh ideas, whether it be the tech bubble, whether it be, digital currencies, whether it be AI, whatever the newest thing is. And I think
you're the first to lose money.
Well, I think that you're going to experience some extreme volatility, and I think it's more difficult to pick out the specific areas that are actually going to be profitable. I think it's more challenging. And so in a way, I think you have to take a little bit more of kind of a shotgun approach on those things if you're going to consistently kind of be early to that game, if you're going to be an early adopter.
Flip side, you also may make more than anyone else who's late.
Or if you diversify too much, you may lose on 99 of them and make on one, right? And eke out the same return with a ton of pain and volatility. I mean, you just can't predict that. You just don't know.
What did Bitcoin originally sell for?
What it come out at?
Or something?
I think it came out at I can't remember. I thought it came out at $1, but I can't remember.
Okay.
It came out. Matter of fact, it traded under $1 for a long time.
Okay.
When people were mining it.
Yeah.
So I don't remember what it came out at.
Yeah. Okay. I don't know, but that's my point too. There with that is like, you can wait until you feel like it's safe, quote unquote, and then miss the run up or whatever. Or you can be in early and just bounce along the bottom for a while until something happens.
But the concern is, how much do you put in there? How much do you throw at it?
Yeah.
And how does that impact whether you retire at 60 or 65?
Yeah.
Right? And how does that impact if little Susie goes to college and if you're planning on helping to pay for it, or if Johnny wants to get married and buy a house or start a business and you want to help Johnny out with that, right?
Yeah.
And so you've got to take a step back and kind of keep those emotions and excitement in check and say, how does this really impact my goals and my life decisions as to what I'm trying to do? Because it's really easy to get so excited and make a terrible financial decision and kind of go all in, right, on something like that. And then all of a sudden you're wrong and you're left holding a bag of nothing. And so that's hard.
There's this place called Las Vegas. It's fun too.
Oh yeah.
There. Yeah.
Were you an early investor?
No. Well, that's interesting. So then, Rex, what do you tell your clients? Do you say, look, listen, the way you're positioned, you've got, a certain amount of money that if you want to, you can do whatever the hell you want with that much money on, because the rest is invested appropriately, then you could take that and just do whatever you want with it. And I guess, like, what do you tell your
So you're trying to get to the client, the best part of our thing. Let me read one more and then we'll jump back to it. We're going to table it one.
Stay tuned.
Yeah. So this last one, economist at InfraCap, and it's interesting to just get these perspectives from all over. And so this one I think is really interesting. He says,
Infra.
Cap. It says, in 11 out of 11 post-World War II recessions, there were significant tightening of monetary policy, with 7 of the 11 recessions resulting in a yield curve inversion. And when we say significant tightening in monetary policy, right, that's the Fed raising rates, it's constricting the money supply, right? It's doing things, the Fed essentially making it more difficult to get access to money, raising the cost of money. Is that just?
Yeah, and yield curve inversion essentially also just means that short-term interest rates are higher than long-term interest rates, meaning that if you buy a 1-year CD or bond or interest rate, it's something paying you interest, maybe that's paying you 5% for an example, or 6%, and if you go out and you buy a 10-year same kind of instrument, that 10-year instrument is only going to pay you maybe 4%. And so it's sloping downward. The longer you tie up your money, the less you're making, which traditionally indicates that the banks, the financial institutions, the issuing bodies of that debt are more bearish on interest rates, meaning that 10 years from now, that's where they think interest rates will be. And so they don't want to pay you some higher interest rate and be tied into having to pay that for 10 years because they think it's going to be less than that, and they think that they can do that lower. And so that's why when we get into an inverted or short-term rates higher than long-term rates, that's also a signal as far as what the anticipation is.
And that's a big one. People throw flags all over inverted yield curve, but I think making sure you understand what an inverted yield curve is, and it's essentially the markets and financial institutions betting the interest rates in the future will be lower than they are today. Because usually if you're going to tie up your money for longer, you get more money for it. But in an inverted yield curve, it's just the opposite. And investors are willing to pay for that because, man, it's going to be longer. And we're even seeing that today with CDs, where you can go out and if you get an 18-month CD, its yield is better than a 3 or a 4 or 5 year CD because institutions think interest rates are going to come down. Typically what that means is they worry there's some sort of recession, so the Fed is going to bring interest rates down. And so that's kind of the psychology behind it.
But also rates are fairly high right now, so you would assume they'd be lower.
High relative to the last 10 years.
Yeah.
For sure, yeah. But
okay.
Anyway, so rising long-term interest rates and the tightening of monetary policy causes a significant decline in the housing market. And that's kind of what we talked about traditionally, right? When you raise those rates, it makes it hard to build houses. The average recession produces a decline in housing starts or new construction of 940,000 homes or 48%. The worst decline was during the Great Recession, so that's 2008, a 79% decline. So kind of the argument that, hey, if monetary policy gets really, really tight, that hurts the housing market because nobody can, it makes it harder to build a house, harder to afford to build a house. The decline in housing starts results in mass layoffs in the construction sector with an average job loss of over 14%, 14% representing almost a 1 million job loss, with the Great Recession experiencing 2.3 million job loss or a 29% decline. So essentially, hey, if the banks make it hard to build a house, then what happens in the housing sector? Well, they all get laid off, right? And what happens if they all get laid off? The decline in construction also leads to a reduction of manufacturing jobs as consumer durable demand is primarily driven by house construction, right? So fewer people buying fridges, washers, light bulbs, fancy LED light bulb, whatever it is, right? That all comes down and is negatively impacted by higher interest rates as well. The mass layoffs from the housing and consumer durable sectors result in a reduction in consumer demand from laid off workers and ripples through the rest of the economy. So that's the argument, right? Is that, hey, if we get this tight with monetary policy, it's gonna, people will stop building homes. If they stop building homes, you're gonna see layoffs. If you see layoffs, you're gonna see people not buying as much stuff. And you see that cycle, and we've seen that cycle multiple times through history. However, it goes on and says, but this time it's different, right? And they go through all those things. We've seen the interest rates come up. Why hasn't housing fallen off? Well, because we didn't have a surplus of housing. In fact, we're desperately short on housing. And so their argument is that, hey, yeah, in the past, sure, that's been accurate, that tightening policy hurts housing market and layoffs and recession, but this time there's a lot that's different. And Ameriprise, Russell Price, he would argue kind of the same, that the consumer is dramatically more healthy today than they've been going into past recessions. Usually going into recession, you see this economic boom and people get overly optimistic. They feel really good about their future. They increase credit card debt. They increase their houses, their cars. They get over leveraged, and then all of a sudden it gets tight and they can't, right. And that produces a huge downside. That wasn't the case. Since 2008, consumers have actually kept their debt relative to their income very, very manageable. And so now we're in a position that's probably unlike most of the others, where the consumer's still healthy, consumer still has cash, consumer's income, because the job market is still really, really good, which is partly due to demographic shifts. So you got a strong consumer. You've got housing that still, I mean, we still need more houses. So the likelihood of housing just completely collapsing is probably a lot less than in the past. And so kind of the argument is that, hey, this time's different.
It's interesting because, you know, all the logic is solid on all of those opinions.
Sure.
Right?
Sure.
And yet every time
How are you going to argue with these people?
I know. Every time I hear this time it's different, I just I just raise an eyebrow and I think, oh my gosh, here we go again. Because, you know, I hear people say during the .com bubble, right? Oh, this time it's different because now we've got technology, we've got the internet. This time it's different, right? With 2008 and the Great Recession.
Well, it never is exactly the same.
It never is exactly the same.
It's always a little different.
But patterns are similar.
Sure.
Right? And there's always, it's like kissing cousins, right? I mean, there's always some neighboring, you know,
okay,
as far as that goes. And so
I don't think that goes far.
I don't know where I'm going with kissing cousins, but they're not brother sister. That's the point. Okay. Is they're not the same family. They're not related.
Yeah,
so
even worse. Okay. I don't know. Okay. All right. Well, what does it mean? But what does it mean, Brandon?
But you have to look at the overall economy too, right? I think that's a very, you know, if we were saying this time it's different, that, yeah, sure, companies are all way overvalued. Sure, you know, we've seen a massive run in the market and the earnings haven't kept up with it. But this time it's different. I'm 100% on that side. Like, hey, let's right. Ultimately, it comes down to earnings. But our ratios are fairly neutral, and I think right now the main concern is the concern of the future. Where is the Fed going, and how much pain is this going to inflict? And really nobody, including the Fed, understanding how sticky inflation is going to be. And I think that is the kicker, and that's what gets us to so what do we do?
But I think it's the things that we don't know. And decisions that people are making that we don't know, that hasn't come to light yet. So like the banking issues that happened earlier this year, right? Part of the core issue of the banking issue is that those banks put a lot of their capital into longer bonds, right? And that's at the core of it, that's part of what happened. And so they had a bunch of this money that they needed to keep as reserves tied into longer bonds. Interest rates went up, bond values dropped, and then they had all these companies that needed access to capital. And so they were having to sell those bonds at a loss, which was driving those companies under. And that's where the Fed and the FDIC had to come and step in and kind of save those banks. Who would have guessed 3 years ago that these bank presidents and bank managers are putting all of this reserve money when interest rates are close to zero into long bonds, knowing probably in the back of their head that at some point over the next 3, 5, 7 years, interest rates are going to go up and those bonds are going to drop in value. I'm not sure. I would have never anticipated that they would have done that.
Me neither. But they thought if rates go up, surely it'll be like it was in the past. It won't be different, right?
Like a slow rise?
They'll slowly bring them up, and man, it just came up overnight, and that's what caught them.
But that's the fear, right? Is what else is out there that we don't know yet?
And how many
hasn't come to light?
How many meetings? How many economists have you listened to? They're like, look, rates are low forever now, right? Rates aren't going back up.
It's a new normal.
This is the new normal. Yep, and that's what everybody was saying. Right. And I think a few of these banks just fully bought into that, and they said, well, if rates are always going to be lower, then I'm going to extend out that duration. I'm going to extend the length of this bond and get a little bit higher interest rate because that's going to pad my profit.
But that's the saying, right? The bank presidents were saying, oh, no, this time it's different.
Right. Yep.
Right.
No,
I mean,
you're
that
right.
Just ties
you're
it
right
back around. This time it's different. Therefore, I can do long-dated bonds and
Yep.
and be safe. And that's why we're having an issue both in the banking sector and the insurance sector because the insurance companies have done very similar things, and so they're having to raise your insurance rates on your home and auto and everything else because they're getting into that same similar capital crunch, and so that's the same issue. And so if everybody starts saying, "Oh, this time it's different," and people start making financial decisions based on this time it's different, then what kind of problems is that going to present us with a year or 2 or 3 from now?
Right. Which gets us into a perfect segue to answering Brandon's question.
It's about damn time.
Long awaited, highly anticipated.
So what does this do for your investment portfolio, right? All these opinions, all these ideas, that all have some solid ground. So what, right? What do you do? And we've got clients that we get into these fun conversations where we're going down every which way and ultimately wrap it into, so what does it mean? And almost, in my opinion, it's almost laughable, because the answer is always the same. Whether we're in a really, really strong market, whether we've got recession concerns or we're building out of it, the answer is the same. The answer is we cannot predict what the markets are going to do, and therefore we need to build a portfolio that can withstand, that can capture on the upside, right, if the markets continue to go up, but also meet the distribution needs of the portfolio. Meaning that if you're getting close to retirement or you're in retirement, we need to make sure, no matter what the stock market does, that we're going to have, monies that we can access, that we can sell, that's a little bit more stable, that we can get through any sort of economic downturn, because we just cannot predict with certainty what's going to happen in the market.
The difficult thing on that is when you get into a year like last year, 2022, where most asset classes are down, right? And so you had the stock market that was down, the bond market was down, bond markets drop when interest rates go up. And that was the most difficult bond market, in my opinion, that we've seen since probably 1994, for a long, long time. In 1994, I think they raised interest rates 14 times during that 12-month period. It was an enormous interest rate height, tightening cycle during that time period. And so even with a well-built portfolio to where you're anticipating that, you still can get caught on occasions in a year like that. And so we still need to make sure that we've got the cash flows and that we're taking, that money from places that's a little safer and more secure. And then it's easy to get a little overexcited during the up markets and get out of that balance. And I think that that's where a lot of people that are kind of doing it on their own get into trouble, is they're not rebalancing, they're not bringing things back into alignment after big market run-ups. And I think you really need to be careful of that.
Yeah.
What happened in 94 or before 94? Why did they do 14, whatever?
So in the early 90s, you had two things going on. You had the first Gulf War, right, in 91, and then you also had the savings and loan debacles that happened at that time, to where you're getting a bunch of bank failures. And so that caused a very loosening cycle, to where they brought interest rates down quite a bit and loosened up the economy. And then we were coming out of that again, not to the extent that we're in today, but there was a high money supply, and so they needed to tighten that up, and so they needed to kind of bring that back up to a more reasonable level to make sure that we didn't get into a high inflationary cycle. And that's what was going on back then.
Okay, sounds good. Did I ask you about any more numbers for this podcast?
No, but I've got them.
All right, sweet.
So this is by Credit Karma. There's a study. 33% of Americans said they knew the net worth of one or more celebrities. Right? Have you ever played that game? I know my wife and I, we do. We're like, how much are they worth?
Yeah, but so it does, like, even Wikipedia or something puts it out there, like, it's probably worth about this much money. I'm like, how in the hell would they know? Like, what do they know?
It's not public information necessarily. Yeah, no, there's some speculating, I'm sure.
They base it off of how much they made, right? Over a certain amount of years.
Well, and what they did with it, right? I mean,
guess.
Because ultimately net worth, and this gets into, right, how do you calculate net worth? You take all of your assets, you subtract off all your liabilities or all your debts, and whatever is left over is your net worth, right? It kind of, if you were to decide, hey, forget this, I'm going to sell everything, pay off all my debt, and just go on a, lifelong vacation, what would that number be? After you'd sold everything, paid off all your debt, what's that number? That's your net worth.
$5.
That's one of the most important numbers for people to know, in my opinion, because most of your major life decisions, major financial life decisions, should be made with your net worth in mind. As far as over a certain period of time, is this going to increase my net worth or decrease my net worth?
Yeah, I feel like there's a lot of celebrities that don't care, because they'll just they'll be, let's say, like in their personal life, they'll just make decisions that just destroys their net worth.
Yeah, I think they've got a lot of people sitting at the table, right, that they're trying to feed financially and probably otherwise also.
Sure.
But I think I think it's tough, because I think it's emotional decisions, and I think when their best friend comes and says, hey, I've got this great business idea, I've always wanted to do it, it's definitely going to make money, for sure. No questions. Do it.
I mean, FTX, he took out quite a few of them.
Yeah. Yeah. He took out a bunch. I think we played the same game, right? Guess your net worth. And it's interesting because I think a lot of those pages are fairly close because my gut feeling is that some of the people pay to get kind of what the number is from the bank and the lending institutions and so just like the politicians leak information, my guess is other people leak information from time to time.
Sure.
It says despite knowing the net worth of celebrities, more than half, about 51%, said they had no idea how to calculate their own net worth.
Wow.
And so if you're listening to our podcast, you know how to calculate.
If you're part of the 51%, give us a call.
Yeah. No, it's good. It's good to know. It's good to calculate, and it helps you. It changes the way that you make decisions oftentimes, where you put your money. So
yeah.
Good stuff, gentlemen. Thanks so much. Follow Through the Pines on Instagram, Through the Pines, and on YouTube, Through the Pines Podcast. I think that's a wrap. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.